Hey everyone, and welcome back to Dollar Basics. Have you ever thought, I'd love to invest, but I just don't have enough money? Maybe you've seen stories about people making millions in the stock market and assumed you need thousands of dollars just to get in the game. Well, I'm here today to bust that myth wide open. The truth is, you can start investing with as little as $100. And in this video, I'm going to show you exactly how to do it, step by step. This is the complete beginner's guide to turning that $100 into a powerful wealth-building tool. I truly believe that you don't need to be rich to invest. You need to invest to become rich. It's all about starting no matter how small. Think about it this way. That $100 could be a nice dinner out, a new pair of shoes, or it could be the first seed you plant for your financial future. Over time, that seed can grow into a massive tree. The key is compound interest, which Albert Einstein supposedly called the eighth wonder of the world. It's the process of your earnings generating their own earnings. The earlier you start, the more time your money has to work for you. So, forget the idea that you need a fortune to begin. Today, we're starting with just $100. Let's get into it. First things first, you need a place to actually buy your investments. This place is called a brokerage. Think of a brokerage as a specialized store for stocks, bonds, and other investments. Just like you'd go to a grocery store for food, you go to a brokerage for financial assets. Now, choosing a brokerage might sound intimidating, but it's gotten incredibly easy and cheap in recent years. In the past, you had to deal with high fees and commissions that would eat up a small investment like ours. But today, most major online brokerages offer zero commission trades. That means you can buy and sell stocks without paying a fee for each transaction, which is a game changer for small investors. So, which one should you choose? There are tons of great options out there, like Fidelity, Charles Schwab, or Vanguard. There are also newer AIP-based platforms like Robinhood or Webull that are very popular with beginners because of their user-friendly interfaces. My advice is to look for a few key things. First, zero commission trades. This is non-negotiable for a small account. Second, no account minimums. You don't want a brokerage that requires you to deposit $1,000 just to open an account. Third, the ability to buy fractional shares. This is a big one. Fractional shares let you buy a small piece of a company's stock, even if you can't afford a full share. For example, if a stock costs $500 a share, you can still invest your $100 to buy 1/5 of that share. This feature is crucial for making your money go as far as possible when you're just starting out. Take a little time, do a quick online search for best beginner brokerage accounts, read a few reviews, and pick one that feels right for you. The sign-up process is usually straightforward and can be done online in about 15 minutes. All right, so you've opened your brokerage account and deposited your $100. Now what? The account is funded, and you're staring at a screen with lots of charts and numbers. It's time to understand your investment options. Don't worry, we're going to keep this simple. With $100, we're primarily looking at two main choices: individual stocks or funds. An individual stock is exactly what it sounds like, you rebuying a small piece of ownership in a single company, like Apple, Amazon, or Tesla. If that company does well, the value of your stock goes up. If it does poorly, the value goes down. It's straightforward, but it's also risky. Putting all your money into one single company is like putting all your eggs in one basket. Your other main option is a fund, specifically an ETF, which stands for Exchange Traded Fund. An ETF is a collection of hundreds or even thousands of stocks all bundled together into a single investment. Think of it as a pre-made basket of eggs. Instead of betting on just one company, you're instantly diversified across many. For example, you can buy an S&P 500 ETF. This one fund holds stock in the 500 largest companies in the US. So, with one purchase, you own a tiny sliver of Apple, Microsoft, Google, and 497 other major businesses. For most beginners, this is a much safer and more reliable way to start. It gives you broad market exposure and smooths out the ups and downs of any single company. So, you have individual stocks higher risk, higher potential reward, and ETFs lower risk, more diversification. Now, let's dig a little deeper into that choice. Index funds versus individual stocks. As a beginner with just $100, which path is better? Let's be real. Picking individual stocks can be exciting. It feels like you're betting on a winner, and if you're right, the payoff can be huge. But it requires a lot of research. You need to understand the company's financials, its competitive landscape, its leadership, and its future prospects. For a beginner, this can be overwhelming, and let's be honest, even professional stock pickers get it wrong all the time. The risk of picking a losing stock and watching your $100 shrink is very real. This is why I almost always recommend that beginners start with index funds or ETFs. An index fund is a type of fund that aims to track a specific market index, like the S&P 500 or the NASDAQ 100, because they passively manage, meaning a computer is just mirroring the index. Their fees are incredibly low. By investing in a broad market index fund, you're not trying to beat the market. You're simply trying to be the market. And historically, the market has gone up over the long term. This strategy is endorsed by legendary investors like Warren Buffett, who has said that a low-cost S&P 500 index fund is the best investment most people can make. It's a simple. You get instant diversification, you minimize your risk, and you put your money to work in a way that has historically delivered consistent returns over time. So, for your first $100, an S&P 500 ETF is an absolutely fantastic choice. Okay, decision made. You've chosen a brokerage, funded your account, and decided on a low-cost index fund like an S&P 500 ETF. Now for the exciting part. Making your very first investment. This is the moment you officially become an investor. Don't be nervous. It's easier than ordering a pizza online. First, you'll need the ticker symbol for the ETF you want to buy. A ticker symbol is a unique set of letters that represents a particular investment on the stock exchange. Some popular S&P 500 ETFs have symbols like VU, IVV, or SPY. You can find these with a quick search. Once you have the ticker symbol, log in to your brokerage account. Look for a trade or buy button. Click it, and a trade ticket or order form will pop up. Here's what you'll do. First, enter the ticker symbol of the ETF you chose. Next, you'll be asked for the quantity. Since we're using fractional shares, instead of entering a number of shares, you'll likely select an option to buy in dollars. Enter $100 then. You'll need to choose an order type. The two most common are market order and limit order. A market order buys the shares immediately at the current market price. A limit order lets you set a specific price you're willing to pay. For your first purchase, a market order is perfectly fine. It's the simplest and ensures your trade goes through right away. Review the details. One last time, ticker symbol, $100. Market order and, then hit that confirm or place order button, and that's it. Congratulations. You just made your first investment and are now a part owner of 500 of the biggest companies in America. You've made your first investment, which is a huge step. But investing isn't a one-time event. The real magic happens when you do it consistently. This brings us to step 5. Set up automatic investing. This is probably the single most important thing you can do to ensure your long-term success. Life gets busy. It's easy to forget to make your next investment, or to talk yourself out of it. Automatic investing takes the emotion and forgetfulness out of the equation. It's the set it and forget it approach to building wealth. Almost every modern brokerage allows you to set up recurring deposits and investments. You can tell your brokerage to automatically pull a certain amount of money from your bank account every week, every 2 weeks, or every month, and automatically invest it into the ETF you chose. Maybe you can afford to add just $10 or $20 a week. It doesn't sound like much, but it adds up incredibly fast. This strategy is called dollar cost averaging. By investing a fixed amount on a regular schedule, you buy more shares when prices are low and fewer shares when prices are high. It disciplines you to keep investing through market ups and downs, which is crucial for long-term growth. So, go into your brokerage account settings right now. Find the automatic investments or recurring transfers section and set something up, even if it's just $5 a week. Automate your financial future. Your future self will thank you for it. So, what happens to that initial $100 over time? Let's look at the power of compounding. Let's say you invest that $100 in an S&P 500 index fund and you never add another penny. The historical average annual return of the S&P 500 is around 10%. If we assume that average, in 10 years, your $100 could grow to about $260. In 20 years, it could be around $670. In 30 years, it could be over $1,700. And in 40 years, it could be worth over $4,500. That's from a single, one-time investment of $100. But now, let's see what happens when you automate it. Let's say you start with your $100 and you add just $50 every single month. Sticking with that same 10% average return, after 10 years, you would have invested a total of $6,100. But your account could be worth over $10,000. After 20 years, you'd have invested $12,100, but your account could be worth over $36,000. And after 30 years, you'd have invested $18,100. But your account could be worth a staggering $105,000. This is the incredible power of consistency and compound growth. Your small, regular contributions turn into a serious nest egg over time. It's not a get-rich-quick scheme. It's a get-rich-for-sure plan, as long as you stay disciplined and give it time. All right, let's wrap this all up with your action plan. I don't want you to just watch this video. I want you to take action. So here's what you need to do. Step 1. This week, choose and open a zero-commission brokerage account that offers fractional shares. Step 2. Link your bank account and deposit your first $100. Step 3. Research a low-cost broad market index fund like an S&P 500 ETF. Find its ticker symbol. Step 4. Place your first trade. Buy $100 worth of that ETF. Experience that feeling of becoming an owner. Step 5. Immediately set up an automatic investment plan. It can be as little as $5 or $10 a week, but just start. The journey of 1,000 miles begins with a single step, and your journey to financial freedom can begin today with just $100. Do you let fear, or the feeling that you have enough money, hold you back any longer? You have the knowledge, you have the plan. Now, all you need to do is execute. Thank you so much for watching. If you found this guide helpful, please hit that like button and subscribe to Dollar Basics for more simple, no-nonsense financial advice. Let me know in the comments when you've made your first investment. I'd love to cheer you on. Thanks again, and I'll see you in the next video.